All right, how's it going, everybody? And this is our Introduction to Options class. Just a quick disclaimer, none of this is, financial advice, and it's all for educational purposes only. So let's just get right into it, starting off with what are options? An option contract gives you the ability to control 100 shares of a stock for a certain period of time. Options can be used to provide income, as stock insurance, or even to leverage a position. Options can be relatively safe, or they can be extremely risky depending on how you use them. You do have a lot of options when it comes to trading options. So let's go over a quick, options terms that you need to know before you get into everything else. So first one I want to go over is the strike price. And the strike price is the agreed price that the 100 shares will be bought or sold at between the two parties. Premium is essentially just another name for the price of an options contract. And implied volatility, the implied volatility is essentially how much a stock is expected to move. Essentially, so when implied volatility is high, that means options will be more expensive and vice versa. The reason for this is because, if people are expecting a very large move in a stock, people will be betting on that large move with option contracts. A good example of that is right before earnings, implied volatility usually gets really high. Right after the earnings call, it drops because, that move happened and people know exactly what happened in the earnings call. DTE, that stands for days until expiration, and that's just the amount of days until the option expires. So now we're going to go over the two different types of option contracts that you can trade. First one is a call option. A call option will give the buyer the right to buy 100 shares of stock at the strike price. So it's a bullish trade. Put options are the opposite. They give the buyer the right to sell or short 100 shares of stock at the strike price. So that is a bearish trade when you buy a put option. Another option term that we can go over now that we know that is in the money, or ITM. And in the money options are options with a strike price that is favorable when compared with the current stock price. Conversely, out of the money, or OTM, are options with a strike price that is not favorable when compared with the current stock price. For example, if a stock is trading at $100 per share, a 90 strike call option would be in the money. And that's because, a call option is a bullish trade. You're buying the right to buy shares of the stock at 90 while it's trading at 100. And that's obviously in the money because if you exercise that call, you would own the shares at 90. And if it's trading at 100, that's favorable. It's in the money. On the other hand, a 110 strike call option would be out of the money because you obviously don't want to buy a stock at $110 if it's trading at 100. That is not in the money. So that would be out of the money. Now let's go over the Greeks real quick. The Greeks aren't super important to understand just for trading purposes, but there are a couple pretty important ones that you definitely want to know. But let's go over all of them just because this is a full options class. So the first one, and probably the most important for trading, is delta. And that's the percent chance that the option will expire in the money. So if a call option has, a delta of 50, there's a 50% chance that on the expiration date, that option will be in the money. Theta is another very important concept to understand, and that's how much an option decreases each day. Because options expire as time goes on, they will lose value each day, and that is denoted by theta. And the theta will pretty much estimate how much value an option is expected to go down each day, due just the time decay. Gamma is where it gets a little bit confusing, but that's the rate of change of delta. So it's basically how much delta will change, based on a $1 move in the stock price. Vega has to do with volatility, and that will measure your exposure to changes in volatility. Options that are, at the money at the current stock price have the highest Vega. Rho has to do with interest rates, and it's basically the expected change of an option per 1 percentage point change in the interest rates. And rates have been rising lately. And because rates are rising, that actually makes call options more expensive. And pretty much the reason for that is because to buy stock using margin, you're going to get charged more interest. And so it's pretty much reflected in the call options. Color, it's the rate of change of gamma, even more confusing. But charm is the last one I'll go over, which is delta decay. Thing you need to know about charm is that far out of the money options have, the highest charm. So the further out of the money the option is, the more the delta will decay. But now let's go over call options. Buying a call is a cheap way to leverage your portfolio rather than buying shares using margin. Because it's cheaper to buy a call than it is to buy 100 shares of stock. People with small accounts or just people that want to leverage, a trade can benefit from buying calls. However, unlike buying shares of stock, there's going to be expiration dates, so you have to be right that the stock will move up before the expiration date. If the stock is below your call strike price at the expiration, it will be worth zero and you'll lose your entire investment in that case. Whereas with stock, you can pretty much hold it forever. So even though it's cheaper to buy call options, it is riskier. So how to make money buying calls? Again, buying a call is a bullish trade. So you obviously want to buy calls on a stock that you think is oversold and that you expect to go up in the near future. Buying long-term calls that are in the money is definitely the safest method of buying calls if you want to, replace a stock position. And buying short-term calls that are out of the money is the riskiest method, but has a much higher reward potential. Anytime there's a high risk, there's going to be a higher reward, and vice versa when you're trading options. So buying calls with 1+ years, that's called a leaps option, is recommended if you're looking for an equity alternative. In other words, you want to buy a call rather than buy shares of a stock. Just a few notes about calls. Again, options decrease in value each day due to theta or time decay. So you want the stock to increase in value ideally right away after you buy a call for the best results. Short-term options will decay much quicker, which is why they are risky to purchase. You have way less time to be right, and theta is going to hit those contracts way harder. If you purchase an in-the-money option with over a year until expiration, the theta decay will not be as bad, and you'll also have intrinsic value since you're in the money. And just real quick, since I know a lot of people use Robinhood, we're just going to quickly go over how buying an option on Robinhood works. So you basically just pull up a stock and you press the trade button, click on trade options. You pick your expiration date at the top there. Again, for SPY, they have options that expire literally every day now. So you have plenty of options. You can literally buy an option, a 0DT option that expires on the same day now. Pretty much, yeah, every day of the week. After you do that, you go buy and call. You click the contract, change the number to how many contracts you need to buy, review, put your order in. So now let's talk about put options. Buying a put is a way to hedge your portfolio or to speculate that a stock will move down. It's just like buying car insurance, except for your stocks. So you're basically buying stock insurance as a put buyer. You pay a premium to the seller, the insurance company, so that if your stock crashes, you have some downside protection. Just pretty much how car insurance companies work, except for talking about stocks. Let's go over a quick example of buying a put. So let's say you own 100 shares of Apple at $120 per share. You can buy, say, a $100 strike put as insurance. So you own it at 120 and you buy a $100 strike put. If Apple drops to, say, 80 or anywhere under 100, you still have the option to sell your shares at the strike price of $100. So it's a great way to hedge your portfolio in case, stocks drop very hard. You'll be good. But if Apple doesn't drop under your strike by the expiration, again, your put will go to zero. All out of the money options will expire at zero. So is it worth it to buy puts? In the long run, you will statistically lose money as a put buyer, the same way that car insurance companies generally don't go out of business. They make money steady by, just collecting steady income each month, and they only have to pay out for random accidents that don't happen a whole lot. So the premium they collect ends up being more than how much they have to pay out. So as a trader, if you have a long-term outlook, being a net seller of options is the more consistent way to go about it. So let's talk about selling options now. When you sell options, or otherwise known as write an option, you get paid that premium up front. Right when you sell it, it goes in your cash balance in your account. The buyer of the option is the one that pays you this premium, and they're paying you to take on the obligation to either buy or sell their stock, depending on if you're trading a call or a put. So selling puts is just like turning yourself into a stock insurance company. And selling options is a great way to make consistent trades given you're using the proper risk management. And that risk management portion is key because freak accidents will happen and you will definitely have to manage that. It just depends on when it happens and what positions you have on during that time. So let's talk about specifically selling puts. When you sell a put, all you're doing is you're promising to buy 100 shares of a stock by a certain date from the put buyer. You're selling stock insurance to the put buyer, essentially. So they're saying, if this stock crashes, you're on the hook to buy my shares. And they're paying you a premium for that, to buy, their 100 shares of stock. Same with how a car insurance company says they'll pay you out if you crash your car, given you pay them a premium each month. So in the worst case, you're going to end up owning 100 shares of the stock at the strike price of the put. And even if you do get assigned, on a freak accident, you're still going to collect that premium that you collected upfront as income. Because like I said, it goes into your cash balance in your account right away. So to sell a put option without a margin account, your broker is going to require you to have enough money to buy 100 shares of stock at the strike price, set aside for them as collateral, just in case you are assigned. But if you have a margin account, you're only going to need around 20% of the required capital. If you wanted to use leverage, you can get pretty much 5-to-1 leverage, selling options. When you have the cash, though, to buy all the 100 shares at the strike price, that trade is called a cash secured put. So let's talk about the cash secured put strategy now. So let's say Apple is trading at $110 per share. And so you can sell a $100 strike put that expires, say, in 7 days. And essentially, you're promising to buy 100 shares of Apple in exchange for a premium. In this case, let's say the premium is $50. So all this trade is saying is that you're betting that Apple will stay above $100 within the next 7 days. And if it does, then you're going to keep that premium. To make this trade without margin, you'll need enough money to buy 100 shares at the $100 strike price. In this case, that's $10,000, 100 times 100. 100 shares at $100 each. If you have a margin account, you need roughly 20% of this amount, depending on the stock, or about $2,000. But if the stock becomes more volatile or it crashes quickly, they can require more than 20% at any time. So you have to be really careful if you are selling puts using margin. Let's talk about the potential scenarios of this specific trade. So your strike price is 100. You sold a $100 cash secured put on Apple. And so if Apple stays above that, you get to keep the $50 as income in your account. And the broker, when it expires or when you close it, you get your $10,000 in collateral back to trade whatever else you want. If Apple goes below the strike price on the expiration, you will be forced to buy 100 shares of Apple, but you still get to keep the income of $50 in your account. So technically, if you include the premium in your cost basis, you will own them at $99.50. So it's a quick overview. Selling cash secured puts is one of the best option strategies out there, especially if you're brand new. Like, you know how to buy stock, you know how to trade stock. Selling cash secured puts is a great way, to get into options trading. It's also a great way to buy 100 shares of stock as an investment, because you're collecting a premium for selling the put while you wait to buy shares of ideally a good long-term stock that you might have been wanting to buy anyway. So, if you were to sell a put compared to buying 100 shares of stock at the same exact time, you're always going to get the shares at a cheaper price by selling the put, since you're collecting a premium. But you're not guaranteed to be assigned the shares as a put seller, because, like I said, if the stock stays above the strike price, then you're not going to get assigned the shares, and you're only going to keep the income. So if you're bullish on Apple, you sell a $100 put, Apple goes to $300. No matter what, you're not going to get assigned the shares, and you're still only going to make $50. So that's kind of the downside. But now let's talk about selling calls. Selling a call is a promise to sell 100 shares of stock, pretty much the opposite of selling a put, where you're promising to buy. And again, you're collecting income for writing a call option. You collect the premium that the option is worth upfront, just like selling a put. But in this case, you want the stock to stay below the strike price for it to expire, out of the money. And if it does, you'll keep the premium as income in your account, or either way, even if you get assigned, you do. But you'll also keep, the income if it stays below, and you won't get assigned. But if the stock goes above the strike price on your call option on the expiration, you will be forced to short 100 shares of stock. And again, like I said, you still keep the income even if you are assigned as an option seller. So the most popular short calls or selling call strategy is the covered call. So let's go over this. And the way a covered call works is you have to own 100 shares of a stock. And then what you're going to do is you promise to sell those shares by selling a call against them. And the combination of owning 100 shares and selling a call is a covered call, because if you get assigned, the stocks cover you. So you either wait until expiration to collect the premium regardless, or you can actually take profit early when you sell puts or calls. And the way to take profit early is you simply buy the option back. So let's go over an example of a covered call. So in this case, let's say you own 100 shares of Apple and you own them at $120 a share. You can sell, say, a 150 strike call option and collect, say, $100 in premium for doing this. If Apple stays below 150, you're going to keep the shares in your account and you also keep the income. But if Apple goes above the call strike that you sold of 150, you will have to fulfill your promise and sell the shares at 150. So even if Apple goes to $1,000 per share, if you sell the covered call at 150, you're going to have to sell them at 150. And again, if your shares get called away, you'll keep the $100 of premium regardless, but you, of course, are forced to sell the shares and lose them. So a quick overview of the covered call now. Selling a call is simply promising to sell 100 shares of stock at the strike price. You collect a premium for promising to sell your shares from the call buyer that's speculating that the stock will move up. This is a great way if you own, companies in your retirement accounts and your stock accounts. Basically, you're renting them out and you're making income just for holding them, given, the stock stays below your strike price. But if the stock moves up rapidly above your strike price, you will lose out on some of the profits. Like I said, if Apple goes to $1,000 per share, you're going to miss out on all those profits because it will still be forced to sell at your strike price. So now that we know how buying options and selling options work, let's talk about combining buying and selling options in a portfolio. So to create a stable options portfolio, it's a good idea to have a good combination of both long options, which is long volatility or buying options, and short volatility, which is selling options. Again, like I said, when you buy options, you benefit from a rise in volatility, and when you sell options, you benefit from a decrease in volatility. So theoretically, it's best to sell options when implied volatility is high and buy options when implied volatility is low. So, for example, if you were implementing a put selling strategy like the cash secured put, you could buy puts to hedge your short puts. Similar to like buying puts to hedge your long shares of stock. You're buying a hedge against, volatility. So let's say you sold the 100 strike put on Apple and you collected $100 in premium or $1 per share. You could hedge this by purchasing a $90 put for, say, 50 cents. Anytime you're on the same expiration date, a lower price put will always be cheaper than the higher price puts just because of the way the pricing works. So what you're doing here is you're essentially buying insurance on the insurance you're selling. So you're basically, instead of collecting $1 just by selling the put, you're sacrificing 50 cents of that premium to hedge your portfolio against volatility. And you're also long and short volatility in that case. So if Apple tanks to 80, you will make money on your $90 put that you bought, and it's going to hedge your losses against the 100 strike put that you sold. So again, it's a hedge. And when you sell more premium than you spend on the put side, that is a put credit spread. Put credit spread is when you sell a put and then buy a lower strike put in the same expiration to hedge it. Again, you collect less premium overall since you're spending some of the premium for the hedge, but you have the potential to make money being both long volatility if the stock drops very hard, and you can still make money from being short volatility from the option that you sold. A put credit spread, though, is still a short volatility strategy, and it will lose money if the stock comes down. However, it will lose less money than selling a naked put because you'll have the long option to hedge. All right, so a quick summary of options. Options have many uses and they can benefit pretty much any type of portfolio, whether you want to buy puts to hedge your retirement account when you believe stocks are trading too high and you want to hedge them. You can sell covered calls on your current stock holdings as a hedge as well if you expect the stock to either come down or really not move. And yeah, you can sell puts to, buy shares of stock and get paid a premium to wait to buy shares of stock. And you can buy calls as a way to replace, equity, to replace stock for much cheaper. Since again, buying a call will be much cheaper than buying 100 shares of stock. Plus, with interest rates high, the margin interest that you incur to buy shares of stock on margin or to sell shares short is going to be higher right now. However, that is also reflected in the price of options. So that's it. So now we will hold a Q&A. And so does anybody have any questions for me? I also cannot see the chat. Hands are raised. Okay. Let's see. Let me do this. All right. Mello, you are on the stage, or you should be coming to the stage if you accept the invite. Or Bad Niner. If you guys want to join, I did send you guys an invite to the stage. You guys can also use the chat to ask any questions. What would be a stock you consider easy to wheel? I mean, as far as difficulty-wise, they're technically all the same, but my recommendation for looking at stocks to wheel or to sell puts on and then get assigned would be something that you're bullish on in the long term and that you wouldn't mind owning for a while. If you're talking about easy to wheel as in cheap and you want something that's low price to practice on, to use, not a lot of capital, maybe a stock like Ford, anything with a low share price that's not a terrible company would be great. And plus, Alan and I, or mainly Alan, I usually sell puts on just the SPY myself, but occasionally there will be some good opportunities with some lower price stocks that will call out in the exclusive room for you guys. Like Alan did make a good amount of money selling puts on AMC before earnings because that one has high volatility and it's also a low price stock. So really any stock you're comfortable with. And if it's a low price stock, of course, it's technically less risk, less money on the table. Yeah, so Alexander asked, so selling a covered call means you think a stock is going down, and selling a cash secured put if you think a stock is going up. Yes. However, overall, the covered call strategy is still bullish, but selling a call is a bearish strategy. So if you own 100 shares of a stock and it moves up and you're like, all right, I wouldn't mind selling the stock now, but I also wouldn't mind holding it. You could sell a covered call if you expect it to move down a little bit and collect some premium. And yes, when a stock is oversold, a cash secured put will benefit when the stock moves up. With your experience learning, what has been your biggest challenge with options? Biggest challenge with options is definitely the first few years and getting started, I would say. Because myself, did a lot of self-teaching. I read a lot of books, watched a lot of YouTube videos and stuff like that. So I'd say initially getting started is probably the hardest. And when once after you start trading options for a while and you get that experience, it starts to become more natural. You learn, what to do when certain scenarios happen. And yeah, John said gap downs. Yeah, so when you're selling options, you want the stock to stay relatively stable. So if you sell a put option and overnight a stock gaps down, you mean like it opens way lower, that's like the worst case scenario because you want the stock to stay stagnant, you want to collect your premium as income, and you want to move on. So when the stocks move rapidly, that is definitely a challenge. And that's why I rarely trade individual stocks anymore because you have to worry about earnings, you have to worry about stock specific news, which can cause large moves. Whereas trading an index like the SPX, the SPY, MES futures options, it's generally more stable. Still can be volatile when the overall market's crashing, but definitely not as much as a single stock. PMA says, what is the best way to sell puts that have excessive premium like AMC this week? I mean, the best way, I mean, the only thing, so when you go to sell a put, really all you have to look at is you got to pick the ideal expiration date. And in that case, it's important to know when the earnings expiration is. And what I mean by that, let's just say a stock has earnings on a Wednesday and the nearest option expiration is that Friday. That Friday option will have the highest volatility because it's closest to the earnings date. So if you want to collect the most premium, you would probably want to sell the earnings expiration date. But that depends on the premium and strike prices available. And honestly, I'm always around if you have any questions when you're planning to sell a put. And yeah, it looks like DJR was saying FCEL, FCEL, PLTR, and LMND. I know Palantir is a pretty low price stock. I'm not sure about the other ones, but those are all pretty much growth stocks and definitely will have high premium. Lachlan Mora says, how can I stop buying calls at the top? So that, buying options is a very hard strategy to be good at. You have to, anytime you're trading anything, there's going to be trades that you take that are not good trades. So rather than focus on not buying calls at the top, focus on what are you going to do if the trade doesn't work. And that is called risk management. So maybe set a stop loss if it breaks a certain level on the chart. Just know before you get into an options trade when you're going to take profit and when you're going to get out, or maybe when you already have profit, set a stop loss to guarantee that you don't lose. If I had to start completely over, what would I focus on? Well, if I didn't know anything about options, I think the easiest way to learn is the stuff I just taught you, primarily cash secured puts and covered calls. If you know a little bit about the stock market and you bought and sold stocks before, those two strategies are a good way to kind of combine the two, because the worst case when selling a put, you get assigned shares of stock, so it's easy to grasp more than trading spreads like put credit spreads and stuff like that. So I would start by probably learning covered calls and also cash secured puts, and also talking to us in the call every day, because that is 100% the quickest way to learn. Is you have us to ask all of your questions to whenever you get into trades. All right. I think Mello is typing. Um, if you have a 9 to 5, what would be your strategy to trade? Selling options. I would sell monthly options. I would sell options that expire in, probably 45 to 90 days as opposed to weekly options, because you really don't have to manage them a whole lot. If you sell a put that expires in 90 days, half of that trade is going to be you waiting for the premium to decay. And you can literally manage that. You can look at your portfolio for 10 minutes a day and manage it just fine. Day trading options. Okay. So just recently, um, in like 2022, the end of 2022, on the SPY and the SPX, uh, zero DT options were introduced every single day of the week. So there is several ways to day trade options. You can scalp them, which means you get in and out very quickly. And usually people scalp, the SPX with either buying calls when they believe it's going to go up or buying puts when they believe it's going to go down. That is very much a stressful strategy. I mean, just because it's, even if you're right and the stock moves up right away, the theta is so aggressive that you could still lose money. So that's one way, is to scalp them. Another way is to sell iron condors or iron butterflies. Again, zero DT options. I would not recommend you trade zero DT options if you're new. I would recommend you start with trading 45 to 90 or even 30 to 90 days till expiration options to learn how they work. And then once you get more comfortable and you know how to get in and out of orders quickly and efficiently, you know how to set stop losses, then you can go to day trading options. What technicals are you looking at when deciding on options to play? So the main things I look at when I'm selling options is actually implied volatility. Ideally, I mainly sell puts, and so when I'm looking to sell a put, I'm really looking at the implied volatility of the stock more than anything. And if I think the implied volatility is trading higher than it should be, then that's a good way to know when to sell a put. Obviously, you can be wrong. Black swan events do occur, and that's where risk management comes in. Otherwise, I mean, you could use stuff like the Ichimoku clouds, other technical indicators. Our technical analyst, Fred, is amazing at teaching that stuff. And if you're interested in learning about technical analysis, I would highly recommend you hit up Fred, and that can also be a great way to pick options. Shoot, I did see that one. How do I go back here?
So, Mike, what would you recommend I kind of start learning right away if I have a smaller portfolio, or at least trying first? Would you recommend CSPs or buying equity and selling covered calls?
Well, if you have a define small portfolio, like a couple $1,000s or
Yeah, I'm talking like, hey, I got right around 1,000, maybe $2,000 in my account.
yeah, so since options, you need to trade 100 shares of stock, of course. The smaller your account, the more limited you are. However, yeah, I would recommend that either one, whichever one that you think makes more sense, covered calls or cash secured puts on the small or the low trading stocks would probably be your best option. I mean, if you really want to, because I know a lot of people are really enticed to buy options, I'm not going to tell you not to because I think experience is the best teacher. So you could try scalping options. I mean, it can be fun if you're just practicing and you're willing to lose that money. I don't see any harm, but ultimately, finding a stock that's small enough for you to trade and then just getting that experience trading, I would recommend again either cash secured puts or covered calls. You can't go wrong. They're essentially almost the same trade. So given you find a stock that you're comfortable with trading, I think you'll be fine. And it's a great way to get experience because it's a great skill to learn. you know, if you start a small account, eventually you're going to have a bigger account, and those safer strategies are going to be amazing to know for when you really will benefit from them. Gain, I'm not sure they have the best options.
Do they even have options?
I don't know. But another thing I want to bring up is option liquidity. If you see an option contract and the bid is like 5 cents and the ask is like 50 cents, it's super wide. Do not trade that option because you're instantly going to be losing money. You're literally going to be candy for the market makers trading those options with you because if you buy an option for $50 and the bid is 5 cents, you're instantly down $45. How do you exercise the shares, or does it automatically do it? So, if you're the option seller, you're selling covered calls or cash secured puts. You don't have the buyer has the option to exercise the contract, so it will automatically do it. But if you buy a call and you want to exercise and turn it into shares, you must do that yourself. You have to contact your broker. John brought up Jets is a cheap ETF. ETFs are great for options because it's instant diversification if you want to practice and trade something that's not super volatile. Yeah, Wish only take $50 to get 100 shares, I guess. So yeah, if you really want to practice, those small tiny companies like Wish, obviously they're probably not the greatest investment, but if you're learning how to trade options, it's 100% worth it, I think, just to learn. Okay, bid and ask spread. Let me pull up my broker here for you guys so I can show you. Because the bid and ask spread is important. So, the most liquid stock to trade options on is the SPY. And if I open up something here, you see, well, this is not a great example because it's after hours and they're marking weird, but generally the SPY options are 1 penny wide. So the bid would be 243 and 244. That is perfect. But yeah, if we pull up something like, let's see if Gain has options. They do. So here's exactly what I was talking about. 5 cent bid, 15 cent ask. That is not ideal. 80-cent bid, $1.45 ask. It's not level 2 data like you're saying. You can literally just see the bid and the ask right here. So if you were to buy this option for $1.45, you can, like right now, the spread is so large that you would instantly lose because you can only sell it for 80 cents. I mean, realistically, you're going to get filled somewhere in between, but when you see spreads this large, you do not want to trade that. Does that make sense? Sunita, what do you not understand? Yeah, Ira, you can paper trade on TD Ameritrade's Think or Swim. And yeah, I think, yeah, Webull you actually can too. PAX. If you own 40 shares of PXD, you need to own 100 shares of PXD to sell a covered call, so you would have to buy 60 more. For the bid-ask spread. So you don't want to trade an option when the spread is wide. You see this bid right here? If the bid is 80 cents and the ask is $1.45, that is, you don't want to trade that because it's too large. You want to trade something where the bid is like 80 cents and the ask is 81 cents. I wouldn't go, I mean, a 5 to 10 cent difference is the highest I would recommend that you go. I'm not sure how well you can see my screen. Let me see if I can take a screenshot. Yeah. Here's a screenshot. So as you can see, the bid is 80 cents. The ask is $1.45. That is very wide, and you do not want to trade that. I would show you a better one, but unfortunately, the SPY is not being great right now. Let me try SPX. Because it's after hours, that's why the spreads are wider than they should be. Let's see. Let's try Apple. Here we go. This is a good example. So the one I just posted, that's a 6-cent wide spread. It's not like $60 wide. So that's what you want to look for. You want to, it's called a tight bid and ask spread. It's, you don't want them very far apart because that means hardly anybody is trading those options and you're going to get really bad fills. Does that make more sense, Sunita? Okay, good. Very good to know. That explains when I get into some options trade. I'm down. Yep. Mellow HTX. That is why. Options are not nearly as liquid as stock because there's simply less of them traded as there are 100 shares each. So it's very important to know, the bid-ask spread. Am I missing any more questions here? Doesn't look like it. Yeah, DJ just posted. What can we expect to benefit from the daily calls? Oh, like I thought you meant. Are you talking about call options like 0DTs or our calls? If you're talking about our daily calls, we are for one, before the market even opens, we provide a report for the entire day that Alan will go over in the voice chat. So you know exactly what's going to be happening in the market that day. He's going to go over trades that he's looking at, trades that or news events that you should be aware of. Pretty much everything you need to know about the trading day And then during the actual live market, we're going to be talking about getting in and out of trades. You can ask any of your questions. We'll answer all your questions about trades, literally anything you want us to ask about. So think of us as basically just guys that you can ask about anything you have questions about, or you can just listen in to see what we're talking about, because we are constantly discussing trades and stuff that, you know, everyone should be looking at. Yes, everybody, Sheeb is on Robinhood, if you didn't know. Why don't all stocks have options? Stocks with low volume don't have options because if not even enough people trade the stock, there's no way there's going to be enough people trading the options. And it'll just be the bid-ask spreads will be way too wide and pretty much untradeable. And also, it wouldn't be worth it for the market makers to fill 2 option contracts a day. How to make money with SPX? Well, there's a lot of ways to trade on the SPX. My preferred way to trade the indices is to sell far dated puts. If you want to day trade, I recommend selling 0 DTE iron condors and managing them. I know, Sai, you like to scalp options on the SPX. That's fine. I mean, as long as you limit your risk, and obviously you know what you're doing, you do it all the time. But for me, I would sell iron condors on the SPX 0 DTEs, probably 10 delta or lower for the short options, and or just sell, you know, longer dated put options or iron condors and manage them to collect from OTC stocks. Even if an OTC stock did have options, I would not recommend you trade them, but I don't think any of them do. Iron condors, Louis, is an advanced strategy. It's actually when you sell a call and you sell a put within the same expiration. So think of it as combining the cash secured put and the covered call. You don't want it to go above your call strike price. You don't want it to go below your put strike price. You want it to stay range bound. Sounds like you trade. What happens when you take a loss? Does it not fall under whitewash? I'm assuming you are talking about a wash sale. And so I'm actually looking more into wash sales. I'm planning on writing an article about it and how it works with options specifically. But to my knowledge, I'm pretty sure, and again, the SEC is not clear completely, but I believe wash sales don't occur if you don't trade the same strike option. So, so yeah, if you sell a put, you take a loss on it, and then you sell a put with a different expiration and or strike, I do not believe that is a wash sale. But again, I will be looking into that more because the SEC is not very specific about it. They literally just say a security that's similar in, you know, basically it's a similar security. That's the most detail I've seen. So I'm gonna look into that more, and I will put it out in an article soon. Also, we have tons of articles on all of these strategies on the HaiKhuu website under Insights, under Education. Also, yeah, they're on the Discord Education tab. Let me go ahead and point that out here. So under hashtag options education, we have articles on practically everything I just went over. You can go ahead and click that and view all of ours. Yeah, we do have one, John. We have an article on iron condors, cash secured puts, the wheel, covered calls, theta decay, implied volatility, zero DTE options, iron butterflies, broken wing, everything you need to know about options. You can find it by clicking the options education tab and scrolling up. Yeah, it is a strangle, Louis, except for you buy the wings. So instead of just a short strangle, you would also buy a put and buy a call, which limits the risk. And I highly recommend you go through the options education tab because there's lots of great information there. There's also technical analysis education and fundamental right above those. Is there any final questions? I think this is a good class. Glad to answer any other questions you guys have. Flawless, I'm low-key scared to let you in, but, well,
No, I was just trying to figure out how the hand raising worked because no one said anything. That's why. Just to
yeah, I'm not sure if people understood either, but
yeah, no, that was it.
Alexander, just to reiterate, if I think a stock is going down, I want to sell a covered call. Yes, you're right, but you have bullish and bearish mixed up. Bullish means going up, bearish means going down. But yeah, selling a call is bearish, you want it to go down. Selling a cash secured put is bullish, you want it to go up. It's the exact opposite of buying options. Selling a put is bullish, selling a call is bearish. Buying a call is bullish, buying a put is bearish. Yes, Adi, we do have, we're going to have more classes. We have another guy named Fred. He's our technical analyst. He'll teach you how to read charts. I will teach you guys the options. So definitely, you can definitely look forward to more classes. And Fred is awesome at what he does as well. So I highly recommend you tune into his classes. Yes, that is a thing, Mello, and Fred will help you out all about charting. He's very good at explaining how to read charts. I'm sure we can talk to Fred sometime this week about setting one up for you guys. Sunita, if you want to trade a covered call, yes, you need 100 shares. If you want to sell a cash secured put, you need enough money to buy 100 shares. What I do, the MES futures options is the same thing as SPY, except for you only need enough to buy 50 shares. Mini options. They are planning, so the micro and mini futures options exist. And I think they're even planning on making a product smaller than the micro mini futures options. So, and they just implemented 0DTE, so I would not doubt if smaller and smaller size option contracts were to come out in the future. No, you cannot trade futures on Robinhood. Yes, it's /MES. That is the micro ES futures options. And it has the notional value of 50 shares of SPY. So that's the smallest product you can trade on the S&P 500. But you can't take assignment on MES. It's a futures contract expire, so you cannot buy and sell 100 shares of, well, you can go long a futures contract, but it does expire, so you can't hold them forever like you would shares of SPY. Yes. Those are cash settled except for the quarterly expirations on futures options, which means, like I said, they're cash settled. You cannot take shares. They just pay you out cash or take your cash if you lose. MES and ES are daily now too, Sai. They just added them. Well, I wouldn't recommend trading 0DTs on anything other than SPX, maybe SPY, because the commissions are way too high. Yes, we live in wild times. There's 0DT options every single day of the week. It used to be once a month, then it became once a week, then it became 3 times a week, and now it's 5 times a week. Yep. Nearly half the volume of the SPX is 0DTEs now. It's pretty insane. Yeah, so you do need futures enabled account. If you're a beginner, and I wouldn't recommend them, although it is pretty much the same as trading SPY options, but all right. Any other final questions? Yeah, if you guys have any questions that you can't think of now, which I'm sure you will, join our calls, ask me directly, ask them in the exclusive room, and tag me in the options chat, whatever you want. No problem, guys. But yeah, our server is 24/7 access, so anytime you have questions, just let us know. No problem, everybody. Have a great Sunday, everybody. Looks like we're all set here.
All right. Great class, Mike. Thank you so much. And just like you said, hope you have a great Sunday.
Yep. I hope you guys all have a great rest of your weekend. We'll see you guys bright and early tomorrow.
Take care, everybody.
Later. Peace.
Peace.